Greetings, folks. In the world of investing, there are many paths you can take. Some chase the latest trends looking for a quick buck. But true success, the kind that stands the test of time, comes from understanding the intrinsic value of a business. That's what we focus on at Berkshire, and that's what this series is all about. Finding those hidden gems, those undervalued companies with solid foundations. We'll equip you with the knowledge to navigate the markets with a discerning eye. Now, you might be wondering, what exactly is intrinsic value? Think of it as the true worth of a company, the underlying value of its assets and its ability to generate earnings over the long haul. It's like assessing the value of a sturdy oak tree, not by the fleeting price the wind might blow its leaves around, but by the strength of its roots and the promise of its future acorns. The market, my friends, is like a fickle fellow, driven by emotions and short-term thinking. The price at which a stock trades today might be wildly different tomorrow. That's why we focus on intrinsic value. It's about cutting through the noise and understanding what a business is truly worth. Imagine you're buying a used car. The sticker price is one thing, but you wouldn't just take that at face value, would you? You'd look under the hood, check the mileage, assess the overall condition. You determine its intrinsic value before making an offer. The same principle applies to investing in stocks. Don't be swayed by the daily fluctuations of the market. Instead, dig deep into the company's financials, understand its business model, and assess its competitive advantage. That's how you uncover hidden gems, those companies whose intrinsic value far surpasses their market price. Remember, investing is not about trying to time the market, it's about time in the market. By focusing on intrinsic value, you're essentially buying a dollar for 50 cents, and that's a recipe for long-term success. Now let's talk numbers. While intrinsic value goes beyond just the financials, understanding key ratios can provide valuable insights into a company's health and potential for undervaluation. Think of these ratios as clues in a detective story, each one giving you a piece of the puzzle. One of the most widely used ratios is the price-to-earnings ratio, or PE ratio. It tells you how much investors are willing to pay for every dollar of a company's earnings. A low PE ratio, compared to its peers or historical averages, could indicate an undervalued company. Then there's the price-to-book ratio, or PB ratio. This compares a company's market price to its book value, which is essentially the net worth of the company if it were to liquidate all its assets and pay off its debts. A low PB ratio, again in comparison to its industry or historical trends, might suggest undervaluation. But remember, these ratios are just a starting point. They provide a glimpse into a company's financial standing, but they don't tell the whole story. It's like judging a book by its cover. You might get an idea, but you need to delve deeper to truly understand its value. Think of it like this. If you were buying a house, you wouldn't just look at the square footage and the number of bedrooms. You'd want to know about the foundation, the roof, the neighborhood, and the overall structural integrity. Similarly, when analyzing a company, don't just rely on a few ratios. Look at the bigger picture, the qualitative factors that contribute to its long-term success. Numbers are important, no doubt about it, but they only tell part of the story. To truly understand a business, you need to look beyond the financials and assess its qualitative factors, the things that make it tick, the things that give it a competitive edge. One crucial aspect is the quality of management. Are they honest, competent, and shareholder-oriented? Do they have a clear vision for the future? Remember, a company is only as good as the people running it. Next, consider the company's competitive advantage. What makes it stand out from the crowd? Does it have a strong brand, a loyal customer base, or a unique product or service? A durable competitive advantage is essential for long-term success. Look at the industry dynamics. Is it a growing industry with a long runway ahead, or is it mature and facing headwinds? Understanding the industry landscape can give you valuable insights into a company's future prospects. Finally, delve into the company's financial statements. Don't just rely on the summarized numbers. Dig deep into the footnotes, the management discussion and analysis, and the auditor's report. Look for red flags, inconsistencies, or anything that doesn't seem quite right. Remember, investing is like being a detective. You need to gather all the evidence, both quantitative and qualitative, before making an informed decision. Even the most astute investors make mistakes. That's why it's crucial to build a margin of safety into every investment. Think of it as a buffer, a cushion to protect you from the inevitable bumps in the road. The idea is simple. Never pay the full price for a stock, even if you believe it's undervalued. Always leave room for error, for unforeseen circumstances, for the unexpected. How do you determine your margin of safety? It depends on the specific investment and your risk tolerance. A good rule of thumb is to aim for a discount of at least 30% to 50% from your estimate of intrinsic value. This margin of safety provides you with a layer of protection. It acknowledges that our valuations are not perfect, that the future is inherently uncertain. Remember, patience is key. Don't be afraid to wait for the right opportunity, for that perfect pitch to come your way. As the saying goes, the stock market is a device for transferring money from the impatient to the patient. Building a margin of safety is like buying a car with a good set of airbags. You hope you'll never need them, but you're grateful they're there if you do. In the unpredictable world of investing, a margin of safety is your best friend. Value investing is not a get-rich-quick scheme. It's a long-term game, a marathon, not a sprint. It requires patience, discipline, and a willingness to go against the crowd. While others chase the latest hot stocks, jumping in and out of positions, we focus on finding those undervalued companies with solid fundamentals and holding them for the long haul. Remember, time is the friend of the wonderful company and the enemy of the mediocre. The longer you hold a great business, the more time it has to compound its earnings and create wealth for you. Don't be discouraged by short-term fluctuations in the market. The market is like a voting machine in the short run, but a weighing machine in the long run. Eventually, intrinsic value will prevail. Think of it like planting a tree. You wouldn't dig it up every few months to see how much it's grown. You'd give it time, nurture it, and let it flourish over time. Investing is no different. Embrace the long haul, be patient, and let the power of compounding work its magic. So there you have it, folks. The fundamentals of value investing. It's about understanding intrinsic value, analyzing the financials, looking beyond the numbers, building a margin of safety, and embracing the long haul. It's a journey, not a destination. And remember, the best investment you can make is in yourself. Keep learning, keep growing, and never stop searching for those hidden gems.